Welcome to Yellow Tunnel. My name is Vanna Charm. I'm CEO and founder of Yellow Tunnel. And today I'd like to go over how to trade bullish call spreads using bar chart data and bar chart analytics. For those of you who are new, welcome. If this is your first live event, welcome, or recorded event. My name is Vanna Charm. I'm a founder of Yellow Tunnel. One of the main differences between Yellow Tunnel and maybe other services is that we are data-driven, analytics-driven. We have artificial intelligence tools that helps us with finding trends, finding key support and resistance levels, and provide signals using neural networks. And I've been managing and trading my own money for over 15 years. Since I'm going to go through the bar chart data and bar chart tools, it's very important to look at the disclosures. Trading stock and options obviously involves risk, not suitable for everyone. I'm here to provide ideas about, I'm here to provide signals and how to trade stock and options using option spreads for educational purposes only. And it should not be assumed that the future trade picks will be profitable or will equal past performance. So I'm not a financial advisor, not registered with FINRA nor SEC, and you can see the remaining of the disclosures on the bar chart screen. All right, now that we're kind of finished with the disclosure, it's very important to, let's talk about spreads, right? You can express your opinion, bullish or bearish, using option spreads, right? Options allow you to do leverage, but buying calls, especially out of the money calls or near the money calls, the premium is too high, could be very high. And out of the money, most of the out of the money options expire worthless. So to mitigate some of that risk, you can trade call spreads or option spreads. You can have bullish and bearish ideas. In terms of call spreads, what it allows you to do is cost basis reduction, right? Because if you buy the calls, and especially if the volatility is high, there is a lot of premium you would have to buy for a single call, and probability of stock reaching that level basically less than 70, could be less than 70%. So most of the time, these out of the money options will expire worthless. But during earnings, or when you have a certain opinion, right, on the market, if you think market is going down, or if you think market is going up, or during earnings announcement, matter can go up or down, you can express your opinion, bullish bias, using option call spreads or credit put spread. And we'll talk about implied volatility when you have to do one versus the other. The advantages, the key concepts between bull call spreads, it's a low risk, low reward, and low requirements. The option requirements are lower. The risk is mitigated because you're long and short the market at the same time, and you just expressing a certain bias or opinion. And trade gives up some upside potential, right? If you buy in calls on Meta and Meta moves 20% to the upside, then you do give up the upside on the option spread. That's the disadvantages. So that you're limited, just like cover calls, you're limiting your upside if you're doing bullish call spreads. And we'll talk about probability of success. So how do you set up a bullish call spread? You could sell, there's different ways of doing it. Some people, I'm going to actually go over an example, buy in the money call option, right, and sell an out of the money call option with the highest strike, right? That's the bullish call spread. And usually I just learn one. If I can learn bullish call spread, then I can figure out what the bullish put spread looks like, and what is the bearish put spread looks like, and the bullish and the bearish call spread looks like. So buying out of the money call, buying in the money call option, was delta 70, right? Delta 80 usually for the strike price selection, which is an important topic. We're going to go over it. And you sell out of the money call, right? With the highest strike price. Using same underlying asset, let's say Meta announcing earnings, so you're going to use Meta. Same contract expiration date. You select expiration date based on your view on the market, right? If you trade in Meta earnings, popular strategies are doing spreads, or you can do calendar spreads using weekly options that expire this Friday, right? The upcoming Friday. So you have 5-10 days till expiration. If you have a directional opinion after the earnings and you think, let's say, gold is going to continue going higher, then you can do monthly options, usually 45, 50 days till expiration. And you select strike price based on probability of success and analytics. And we're going to look at the bar chart data to determine how, what is the process of finding these strike prices. So here's an example of what the profit loss look like, right? One is selecting the strike price, which is point A and B. We'll go over that shortly, how you select the strike price. But if you have a bullish bias, you think stock is going to gravitate towards certain price, then those are the strike prices you select. In expiration months, we talked about weekly versus monthly, depending on earnings. Usually I do weekly options. If I have directional view on gold and I think, or market, I think it's going to go up, then I could buy monthly options. And the maximum loss is at strike A, right? You buy in the money call. Let's say, Meta is trading at 450. You're buying 450 and you're selling 460 calls, right? So the maximum loss is the debit that you're paying. So if the stock never goes beyond point A, but it always to the left of A, then this is your maximum loss. If it's in between and the debit that you have paid, let's say this point A is $2, point B is $1, you paid $1. So if the stock doesn't move beyond $1, then that's your break-even point. And anything above the debit price, anything beyond that is your maximum profit minus, the difference in strike prices minus the debit that you paid, right? So that's point B. And that's the upper strike, right? The out of the money call strike. It's a directional trade, right? Depending, if you're buying more expensive call, then this is a debit call spread, and you're bullish on underlying asset. So, what is the return on capital? How do you determine the return on capital? With Bullish Call Spreads, you can pay cost of the long call, right, in the money, and you earn proceeds from the sale of the short call, right? Again, if stock is trading at 480, you buy 480, 485 spread, or 480, 490 spread, then that's the debit that you're paying is the cost, right? So the maximum gain, right? The maximum gain is limited to the difference between the two strike prices minus the original debit, right? And the maximum loss is the original debit price that you paid, right? So with debit call spread, you can never lose more money than you pay. That's why it's a very popular strategy. You can express your bullish opinion, but if the trade is not going against you or not moving in your direction, then the maximum you could lose is the debit that you have paid. And the gain is the maximum, is the difference between the two strikes, point A and point B, minus the debit that you paid. All right, so how do you select the strike price? How do you select the strike price? Let's go into bar chart. So very important, you could see in bar chart, there's a lot of option information. And when you do strategies, very important to decide, do you want to be long volatility or do you want to be short volatility, right? Debit spread means that you want to be long volatility. You think that volatility is going to rise, right? And the stock, especially if the directional trade, and the stock is going to move in your direction. So you do want to look at IB rank, and Meta is actually announcing earnings, just announced earnings today. And you can see going into the earnings, implied volatility is highest, right? The IB rank is reaching the highest point. And usually that's going into the expiration, or going into the earnings event, implied volatility goes up, that's the maximum. And then after, implied volatility is going to start dropping back to historical average. So you can take advantage of implied volatility rise by, again, either, and then you have to decide, but do you want to sell the premium or do you want to buy the premium? Do you want to be long volatility or short volatility? How do you decide that, long and short volatility? You look at implied volatility, right? You look at the skews of open interest. Are there more calls? Are people buying more calls, or are the people buying more puts? If you do see that there is a lot of put skew, right, that usually you want to be selling premium, right? But if you see call skew, where a lot of people are buying, right, buying out of the money calls or selling out of the money puts in large quantities, then you want to then you want to be do a contrarian view and be long the volatility. And long volatility means that you want to buy a debit spread or butterfly, anything that you're paying a debit. So I went to bull call debit spread, and Meta announcing earnings today. And basically, I looked at I wanted to set a filter, right? I want to find the strike prices where there's the high open interest, because the high open interest, even if you don't trade options, high open interest usually shows you where the supply meets and demand, right? There's some people buying options. There's a broker dealer that usually is, selling these options. So here I wanted to see 30,000. It's very unusual. It's very high volume of open interest at specific strike price and a specific expiration months. And it came back as 465, right? So somebody bought a very large volume of 465 calls prior to the earnings, right? Prior to earnings. And we've seen that the Meta is actually traded, closed at 493, and it dropped 12% to 433 after the earnings. So here's an example where somebody bought 40, and I can look at 46,000, right? If you look at if you look at the option section data and you look at the price historical data, you can see that I'm running Meta 465 call, right? And you can see on March 26th, someone bought 46,000 contracts prior to earnings, basically expressing very bullish opinion on the market. In this example, you can buy they could have bought 465 call as a debit call spread, and you have a choice, right? So the screener for bull call debit screener gives you different choices of how much premium do you want to collect, reduce your debit, right? So 465 prior to earnings was $47.45. If you want to reduce it by 10%, then you sell 585 call, and then you have a lot of upside to the market. You can look at the probability of success, and you can look at the maximum profit, right? If you're selling closer to the 465 level, then your maximum profit is reducing, right? Notice how the maximum profit is going down, but your probability of success is increasing, right? Because you are reducing your cost basis, and that's the advantage of the debit spread. And there's no such strategies where your probability of success is increasing and maximum profit is increasing, right? So it's just depends on your view on the market. But it is important to look at the high open interest, right? And we've seen 465, 46,000, and you can actually see that Meta has missed earnings. It dropped below 460, so there is a strike prices that have high open interest act as magnet. You can see because they guided down after the earnings, it actually went through the 460 level, and now it's trading at 430. And there is a high open interest, actually not as much as 46,000, but relatively high open interest at 430 May expiration. So we'll see if tomorrow when the market open, whether the 430 level will or will not hold. I personally think based on implied volatility, calculation of estimated move, the stock should be trading between 420 and 430, and we'll see tomorrow if that's the case. So this is a perfect example where if you were bullish, you could mitigate your risk by selling this, buying 465 call and selling. Or if you're bearish, you could, because you could clearly see that there was not enough put buying at 460 level, you could have done a different. You could buy put spread and express your bearish sentiment, and I will go over that next time. And finally, in yellow tunnel, we do have earnings power trader. Same setup was in Tesla that announced earnings today. And this is an example where there was a very high open interest at 175, and that is the strike price that I sold, and I bought 170 call. Right, bought 170 call. And the advantages of these directional trades is that you know exactly how much you're paying. Here I paid 50 cents, so maybe 30, 40 basis points of underlying stock. But in this example, I closed for 73 cents. Tesla got close to 170, market pulled back. So at this point, I'm not sure if it's going to reach 170, but this is a good example of how you would set up these trades. So again, for spreads, main takeaways are cost basis reduction, You can express your bias, bullish or bearish. You can trade. You have these asymmetrical returns where you risk little. You can have outsized returns, right? You can, in the example of Tesla, you can risk 50 cents to make $5. All right. You cap your gains. Obviously, there's a maximum amount of gains that you can have, but by looking at the high open interest and where supply meets and demand, then usually stock do not go outside of that level, right? They can act as a magnet. In this case, Meta acted as a repellent, but that would be the information that I would look for. All right, you can find more information on yellowpanel.com and join us on social media. And again, I hope you enjoyed this broadcast. Thank you, bar chart. These are some of the tools that you can use. Thank you very much and have a great day.